Hello and welcome to Pro Trader Strategies Market Commentary for Tuesday, March the 20th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. Please take a minute to go over this disclaimer here, basically saying past performance of any trading system or methodology is not necessarily indicative of future results, and I can't really give you investment advice. All right, so having that out of the way, let's get on with the overall markets. We've got crude oil futures right now moving higher by about $1.45. Once we got above this little trend channel that I put in here, that was going to act as resistance, and it just so happened to line up with the 23-day moving average, the 23.6 Fibonacci level and the 50-day moving average. So all of these things kind of coming together, and there's a little volume node over here, should kind of act as resistance in that little node, pulling it back down. Well, the fact of the matter is once we got above that level, above that little trend channel, it blew right through the 50-day moving average, and it had that 23 Fibonacci right on its sights and blew right through that like it was butter. So now we're back above that right here, trading to this volume node right here at 63.50, let's call it. That's where we are currently. 63.58 is kind of where we are right now, and that volume node is right on that level. So right to this volume node, that isn't really unprecedented. One thing to note is to continue this bearish pattern, this market needs to stay below, basically, let's call it $24.50 just to get above that. If it trades $24.50, that means this downward trend is broken for sure. This little trend channel is going to act as resistance, but that's not the end-all be-all. What really happens is if this trades above that, that's going to break that downward cycle there. One thing I forgot to mention was the economic data point. Throwing myself off here a little bit with the disclaimer to try and speed things up. I forgot to talk about economic data. Let's get on with that real quick with over across the pond. It's the only thing we're really getting. And we got German PPI came in. Remember, PPI is producer price index. It's what the producers are paying. And it decreased by 0.1%, was expected to be an increase of 0.1%. We also got Great Britain's consumer price index came in slightly lower than expected at 2.7%, expected to be 2.8%. PPI output came in at a negative 1.1%, expected to be a negative 0.9%, and they revised last month's number down from 0.7%, which was positive, to a positive 0.4%, so a revision downward even there. Then we got the core CPI, which is going to strip out some of the more volatile aspects of that, like food and energy, tobacco, things of that nature. That came in at 2.4%, expected to be 2.5%. Another Great Britain PPI output came in unchanged, expected to be a positive 0.1%. And then that's about it for across the pond for the most part. But what we're seeing here, and I've talked about this a couple of times, a little bit of slowing going on over in Europe and in emerging markets. Here in the United States, we're kind of trudging along here. We're not knocking it out of the park, but we are doing very well. What does that say? Well, when we had the emerging markets moving higher in 2016, what happens there is people are buying emerging markets, European products. So they're using dollars to buy foreign products, which is kind of like a dollar to euro trade-off, right? So that increases the value of the euro. Now we're seeing the slowdown go on over in Europe. What does that mean? Now people that had bought those euro dollars in a sense by doing products and other fashion, maybe it's real estate or whatever, but you're using it you're transferring your dollars into euros. Now we're seeing the slowdown go on over there. We're kind of picking up over here. What's going to happen? Well, we're going to start dumping the euros in order to get those dollars at a higher value. So dollar strengthening, euro should start rolling over just a little bit. Well, what does that mean for the overall markets? Well, the strength in the dollar could start making commodities start to go back down. Crude oil is more of a play a lot of times around supply and demand, but that is something to keep in mind as this market wants to try and push higher. As the dollar strengthens, then we are going to see the overall markets in the commodities start rolling over a little bit. Grains have really had a tough time right now. They are pretty low levels at this point, and going into the season coming up, we're going to start seeing those get a little bit more volatile as well. We'll have to see if the dollar really affects those commodities. In the past, I've been one to say it doesn't really affect those grains as much as one would expect. But having said that, on to gold futures. Gold is an inflationary hedge. It's also a dollar hedge. So we aren't seeing inflation. That should bring gold futures down. Strengthened dollar should exacerbate that whole situation. So I'm expecting it to at least come down to the 61 Fibonacci level here. I think it's going to break this little sideways trend that we've got going, and gold is finally going to start rolling over. I've been bearish in gold for quite a while. A lot of times I am a little bit early, I'm not going to lie. I see these things start to happen, and it takes a little time for it to happen. But I might be adding some gold to the downside, maybe buy some puts or something like that. I'm going to have to play around with that with GLD. All right, so just a little bit of my soapbox on the global economic picture as to what's going on. Pretty funny article I read yesterday. CNBC was like, oh, now Bitcoin is coming back. What do you do? Well, it's really, or it has a huge up day, I think is what they actually said. And it was really barely up on the day. As a matter of fact, I think it was actually slightly down on the day, but it did make a big move. Not a big move for what we are used to seeing in Bitcoin, but a big move for the last couple of days, I guess, if you're pulling on a stretch. But Bitcoin, again, moving a little bit higher today, almost 400 points up on the day. All right, VIX. VIX is moving higher. We got a lot of things going on here. E-mini S&P is pretty much an inside day. We're seeing VIX start to rise because it's really a lot correlated to things that are going on in the tech sector that's really driving this. Facebook, one of the leading markets to the downside the past couple of days that we'll talk about when I pull up that chart. But we got the Dow Jones Industrial Average up 150 points. Looks like a little blip right here, but inside day. You can see even the wicks are inside of yesterday's entire base. That's not an inside day. I don't know what is. And NASDAQ, again, slightly in negative territory after yesterday's big sell-off. We did make a nice move late in the day to try and regain some of the losses. But, yesterday when we were talking, it was down testing this 38 Fibonacci. And boom, once we got below that, it just fell out of bed and tagged that 23.6 Fibonacci level. Actually pierced through it, touched right on the 50-day moving average. I think it just came slightly below it, but you can see it just came down and tested that. And that's when the market started really pushing up and away. All right, on to E-mini S&P. Similar situation. Came down, tested this 50 is what we used to say on the floor, 50, because that way you wouldn't mishear 50 versus 15, because when you say 15 and 50 on the floor, believe it or not, those two sound exactly the same. Or a dozen you would never say, because that sounds like 1,000, and you don't want to do 12 contracts, or if you're going to do 12 contracts, the last thing you want is 1,000 lot, right? But anyway, a couple of floor things that we kind of avoided, but blew below the 50, and then that's what was the catalyst to get that rallying back. As you can see, that was a unstoppable sell-off from the open all the way until we came down and basically touched that 50-day moving average, which was right around here. When you break it down, this is not now a 50-day, it's a 50 bar in a sense. But we did break below that, touch the 50-day, and then that was the catalyst to start rallying up and away. And as you can see, this is confirmation of that inside day right now. It's just very quiet. It's a Japanese holiday as well, bank holiday, so that could be adding to some of this low volatility or low volume. We also have the FOMC tomorrow, where they are going to say whether or not they're going to increase interest rates. They're not expected to, but we're going to have to keep an eye on that as well. I don't think that this is going to be a time. They've been talking about 4 interest rate increases. We're not really seeing inflation. We're seeing a little bit of slowdown globally. Those guys aren't going to increase interest rates, and we are going to blow them out if we start raising our interest rates, because who is going to invest in a Swiss bond that's a negative return when U.S. interest rates are so much higher? Not going to happen. But that's why our Fed has to worry about what's going on globally with the interest rate picture. All right, on to the trades that I'm looking at. FedEx is the last of the earnings for quite some time. We are really winding down the earnings season. FedEx is really the only thing going on this week, and I haven't checked into next week, but I'm pretty sure that it's going to be maybe a 1 or a 2 earnings trades going forward. That's why I've been adding a lot of premium selling strategies right now, because I don't have to worry about that margin of doing 3 or 4 earnings trades. So, but FedEx, I am going to be playing to the upside. UPS is the closest comparable here. And when we had UPS earnings, you can see what happened. Boom, it dropped out of bed. They actually beat on the earnings per share, but fell out of bed. I think that FedEx is actually going to do better. During Christmas holiday, I think a lot more people are using Amazon and associating that with FedEx for the most part. I think FedEx is going to do rather well and not feel this kind of move that UPS had felt. So I'm going to be playing FedEx to the upside. I haven't decided what strikes, but I'm going to be probably selling some puts in FedEx for that up move. As you can see, they have pretty good implied volatility, about where we would expect it for earnings, taking out this big blip here from when we had that massive volatility spike. So it is pretty high as of right now. And then finally, Facebook, I did add maybe a little bit early, but I think that Facebook is going to have some pains going on for a little bit with all of this controversy with Cambridge and Cambridge Analytics, the Democratic Party being allowed to scrape Facebook for data. So there's a lot of things going on here. They're saying, Cambridge Analytics was taking data from Facebook. That's a big deal. But it's not a big deal that the Democratic Party actually went in there and was scraping, illegally breaking terms and conditions of the site by scraping data. And once they got busted, Facebook was like, all right, you go ahead. There's a lot of things going on right now that are not looking too favorable for Facebook. And we haven't heard a whole lot out of the crypto, which I was expecting maybe for the upside. So that not happening. I went in there and sold some calls in Facebook. I did the April 31 days to expiration, sold the 185 calls in there for 61 cents. Like I said, you're probably going to be able to get those a little bit better right now. As a matter of fact, I think they're trading around 75 cents. So, and I might even add a little bit to that position. I don't know yet, but that's 185 handles way up here above this consolidation area. So it'd have to get above the 50. It'd have to get above the point of control, which if it migrates back there, I think it's going to settle down there at least for a little bit with all this information coming out. But it's not looking too good for Facebook and is now in bearish correction territory for the most part. All right, that's it for today. Friday's webinar is going to be a great one. We're going to be doing a long strangle in there. So I'm going to be talking about situations where when you see the market kind of winding up like this, spinning really tight, when they get in those tight little, they're going to break out. And I actually used Facebook as an example for the strangle, or for the straddle 2 Fridays ago. And I was going to put that on, but I went on vacation and never got around to it. And of course, that's why it broke out maybe. No, I think it would have done it anyway. I knew it was due for a breakout in one direction or the other. That's why that straddle would have been perfect. But, hindsight being 2020, I didn't put it on, unfortunately. So jumped in there when we got that volatility spike. But it had, for that straddle, I hope some of you guys that watch that webinar jumped on that one, because that was a great trade. All right, so check out Friday's webinar. I'll be pulling out examples like this of trades that I'm going to put on the Monday. I don't like to try and front run situations like this where I talk about a stock after I already put on that trade. I'm not that guy. I don't like to pump and dump those kind of things. I like to do the webinar, tell you what I'm going to do, and then everybody has the opportunity to jump in there whenever. Wish I would have broken my rule on this one though. All right, that's it. Can't take that. Take it easy.